Well, good morning and welcome to the December 2023 Drilling and Production Outlook Workshop by Spears & Associates. I'm John Spears. This is Richard Spears. I'd like to think that the two of us are the Daryl Hall and John Oates of the oilfield service market research industry. So just want to welcome everybody who's taken the time from...
But without the litigation.
Well, that's true, yeah. Everybody who's otherwise attending the COP 28 conference in Dubai today. Taking the time to come and listen to us as we update our forecast for the drilling outlook here in the U.S. and around the world. So we'll be doing that for the next hour. Richard, why don't you tell everybody kind of what the format is?
Well, I think this will be time for the big announcement, which was it was exactly a year ago that we did our last podcast. Oh. And so the big announcement is we're going to continue to not do the podcast. For all those of you who've been asking, we're going to just set the record straight. You know, for the next hour, John is going to present yesterday's updated drilling forecast, and our clients already have all the data. They've already got the big book, but this particular event is a high-level overview that everybody's welcome to watch. But if you want the data, you got to subscribe, and you can go on spearsresearch.com. and or contact Katie Bewley. She's on there. But one of the things I've noticed, John, as I went through the deck beforehand, which I know surprises you, because it's generally like a duck waking up in the morning, gets a new world.
Here it is.
I saw three things that I hope that I know you'll talk about. Thing number one, despite record investment in alternative energy generation, oil demand continues to rise 1 to 2% a year. Just like it always has.
That's true.
So that's thing one. I'm going to be listening for your conversation about that. Thing two, oil field spending, in light of all of your forecast, we have it up 9% next year.
Yes.
There's a domestic part, there's an international part, and so it gets that 9% with very, very little help from a U.S. market, because the U.S. market doesn't really grow.
Absolutely.
Thing number three that I noticed is that if you count up all of the working drilling rigs in North America, and you compare that with all of the working rigs everywhere else on the planet, the number is about the same. But the spending is stunningly different.
Both in composition, yes, on and on. Yes, absolutely. Right.
What happens on the drilling rig or after the drilling rig, what happens, and the value or the cost of each one of the rigs. Of the rigs running. Right. So anyway, those are the three things I've noticed that you'll talk about. And so if, as you're listening, we are monitoring questions. So if you want to, there's a chat box. They're on YouTube. So type in the chat box. We are monitoring that. You've also got a different way that's linked in there that you can click on the link and submit questions that way. If you have our email addresses, you can email us. Don't email John, because he's doing this. But email Richard, email Chris, email Katie, email David, email the other David. You can do it that way. We'll get it. Anyway, I will turn this back over to you. Okay. And there'll be a couple second pause and off to the races.
Right, and then we'll handle those questions. At the back end of my slide deck. How's that? Okay. Sounds good. All good. Well, like I said, good morning to and welcome to the review of our December 2023 update to the drilling forecast. Those of you who were with us back in September remember that as we met back then, OPEC had just announced a big production cut, and oil prices had rallied from the mid-70s. At the time of that meeting, 3 months ago, they were in the mid-80s. They ultimately peaked in the mid-90s, but have since fallen back. And as we were doing our update this time around, of course, we're looking very much at the OPEC Plus meeting that was sort of happening, trying to imagine what their decisions might be, because as we can read in the papers today, the question was, were they going to cut production further in an attempt to support prices? So I've got a chart in front of you now that on the left-hand side, we look at the change in oil demand. So this sort of sets the stage from a demand standpoint of what the globe is looking at today. And as Richard said, even though alternative forms of investment, wind, solar, whatnot, hydrogen and the like, are rising very rapidly. Good old oil demand continues to grow at pace. This year, 2023, we've seen oil consumption on a global basis rise an estimate almost 2 million barrels a day, as you can see on the chart. Next year's numbers at this point are a tick lower, but still around 1.4 million barrels a day, and we've broken it out by component. So what's interesting there is, the red piece of that left-hand chart is China. China was negative growth. 2022 has come back pretty strong, although there's been all kinds of worries about China in the news. The actual numbers are up pretty substantially this year. But going forward next year, demand growth from China falls pretty substantially based on the current reading for economic growth and the like in that area. Yellow part of the bar is other Asia writ large, and then the blue part is just the rest of the world. So you have to look pretty closely to find that part of the demand numbers that come from the US and from Europe. And in fact, what we see is the US piece at about a 1.1, I should say, million barrels a day growth this year, basically doubles next year. But Europe is expected to slip into negative growth in 2024. So what's really interesting to me is that the US and Europe, if you combine the numbers, then 2024 is going to see 0.1 million barrels a day, 100,000 barrels a day of demand growth next year from the combined US and European numbers. And that's on a consumption base of around 33.8, almost 34 million barrels a day. So a very limited amount of demand growth coming from the industrialized West, really reliant upon China, other Asia, and then other developing economies for the consumption growth we expect to see next year. And given problems with regard to trade and slower growth because of high interest rates fighting inflation and so forth, the consumption numbers are expected to fall. And that, of course, led then to this OPEC Plus meeting, which was all about, do we need to cut our production further in order to support oil prices? Since the production cut that was in effect back in September delivered marginal results, are more cuts needed in order to sustain prices and perhaps lift them from today's level. So we had assumed, since we have to do our forecast, can't wait for OPEC Plus to get this meeting done, we had assumed that the group would decide to just roll over its existing production quota arrangement, which had been expected to expire at the end of December. We thought that would just be rolled over into 2024, that they would not take any action to cut production further. And so it was a bit of a surprise that they announced just yesterday then that they had plans to make further cuts in 2024. But the nature of what they're doing has been basically discounted by the marketplace. What we've seen happen to oil prices since the word came down from the mountain that about OPEC's plans to cut production next year is that no one really believes them. So it's almost like they had an agreement to cut production, but since no one believes them, it hasn't really affected where oil prices stand, which is pretty much the same as our forecast, which was that they weren't going to cut production. So in any case, oil prices today, which are for WTI somewhere in the 76, 77 range, are right where we expected them to be at the start of next year. So we feel pretty good, at least in the early days of our forecast, as to where, as the assumptions we've made around where oil prices might go. And we'll have a slide about that in just a little bit. What's interesting too then is then where's the change in supply coming from? So that's the chart on the right-hand side of this slide deck. And again, you can see that the scales are different between the two charts, by the way, which makes a direct comparison a little bit misleading. But clearly in 2023, the red part of this right-hand chart, OPEC was cutting production this year in an attempt to tighten the market. We expect that their numbers will be down year over year slightly again next year. So we only see about 1 million barrels a day of production growth coming into the market in 2024. And again, that's compared to a demand growth number of around 1.5 million barrels a day. So we think the market over 2024 is going to tighten, which is why we have prices nudging up a little bit from where they are today, but not strongly. And I think that's probably pretty much a consensus view in the marketplace today among traders across the board. So again, OPEC Plus is very interested, as it has been for quite some time, in adjusting its output to stabilize inventories, and we think that that type of the story is going to continue to remain in effect throughout next year. So again, one of the reasons why traders have been skeptical about the agreement to cut production next year is that roughly 1 million barrels a day was announced. Well, 300,000 of that comes from Russia, who has not said that they're going to cut production, but they're going to cut exports. Well, it's very easy for Russia to cut exports in the wintertime because their demand numbers rise so much because it's winter, right? They've got a higher fuel consumption to stay warm in Russia. So them cutting exports in the wintertime really doesn't, I mean, that's pretty common in the marketplace. And so that doesn't really affect what overall supply is going to be. And then some of the other production cuts that people expect are, again, kind of iffy. One of the bigger numbers comes from Iraq, who is overproducing its quota today and intends to drop production by on the order of about 200,000 barrels a day next year, so they say. But one of the problems that Iraq has is that it needs natural gas to fire power plants, and it's short of natural gas, and so it's been taking, there's an arrangement with Iran for Iran to supply natural gas to Iraq, and Iraq is having trouble paying for it. And in fact, they just entered an agreement, a three-party agreement, where Turkmenistan sends gas to Iran, Iran sends gas to Iraq, and Iraq pays for its gas through oil, pays Iran for the gas for oil shipments. So it's difficult in the current situation with regard to Iraq to see how they can cut production so much and still afford to pay for the gas they need and so forth. So I think there's those kind of things which put together have made traders very skeptical about the net effect of how much oil is going to come off the market in 2024, and that's why we just haven't seen much of a price bump in the last few days. The other thing that we keep close attention to, and we've spoken to a number of times in the past, is what's happening to U.S. oil production. And our numbers based on this forecast show very little growth next year. Here's a chart we haven't really presented before, but what it shows is in terms of barrels, how much new production is coming onto the market month by month, and what the decline rate from existing wells has been month by month. So, and again, this is just tight oil production. So from shale plays out in the Permian Basin, Anadarko, Bakken, Niobrara, and so forth. We go back to the early days of 2019, and we extend our numbers through 2024. I think the takeaway that's important for folks to realize is that the decline from existing wells, from these tight wells that we have out there, is on the order of about 600,000 barrels a day each month. So we have about a 6.2% monthly decline rate from tight oil production here in the U.S. So it's a substantial number that we need to replace each and every month out there. And the blue line indicates that, by and large, we've been adding to production. The blue line of the additions have been greater than the deletions, the depletion number, for much of the past 4 years. But the lines are growing ever closer. Some of that might be because initial productivity of new wells has begun to flatten out, and in some cases, in some basins, has been shown to decline. The other bit too is just how many wells are being drilled and completed. And again, I think we're seeing those numbers, and have seen those numbers this year, obviously fall back. So I think operators are clearly getting to the point, deliberately through their investment in new wells, and through the productivity issue of these wells, that they're getting to the point where they're just barely replacing the decline from older wells. And so we think this trend will continue, and that's one of the reasons why our production growth numbers from the U.S. end up being pretty minimal, not only in 2024, but also in years beyond that. We only see less than 1% growth in U.S. oil production over the forecast period, so year by year. So it's a market that's tightening up, which means that oil prices will depend heavily upon OPEC plus production policy, not only for the coming year, but throughout our forecast. There is about 4 million barrels a day, I believe, of surplus capacity in the hands of OPEC as we sit here today. So they have some capacity to feed oil back into the market to supply demand growth over the coming 3-4 years. At some point, one would expect that those surplus numbers essentially get to the point where they're pretty meaningless. And so either oil prices begin to rise rapidly in order to attract investment and reduce consumption, or something drastic might happen. So but that is well beyond the end of our 2028 forecast horizon in this outlook. So, but again, something to keep close attention to is what's happening in terms of U.S. oil production going forward, and we're pretty bearish in terms of what the growth numbers might be. Next slide's about natural gas and our consumption, our estimates of what gas consumption and production are going to look like over the next 4 quarters. And what we see, of course, is that demand numbers on the chart on the left-hand side only show a slight increase, about 0.3% in 2024. The red part of the bar, the larger part, is the consumption of natural gas here in the U.S., and the black part is the export of natural gas, either by pipeline or by LNG. So exports are now 19% roughly of what our total demand number looks like. But the component elements are growing at different rates. The forecast at the moment, anyway, assuming a normal winter weather and whatnot, is that U.S. consumption will be down about 0.5% next year from where it has been this year. But on the export side, exports will be up 4%. And so when you put those two numbers together and weight them accordingly, you get this 0.3% increase in 2024. The export number can't rise much more than 4% just because we're constrained in terms of both LNG capacity and pipelines. So that number looks about right. The consumption figure is the one, besides being weather dependent, is again tightly tied to economic activity. And in fact, those who follow the forecasts that the Energy Information Agency here in the U.S. puts out about gas consumption in the U.S. Will remember that it routinely reports that next year's consumption number will always be lower than this year. So they sort of have a structural bias toward a decline in consumption. And so we'll see if their current forecast proves correct. But it is interesting to note that power generation is the single biggest element of natural gas use here in the U.S. And of course, what we see happening in the U.S. is that demand for coal in the power sector continues to fall. The use of wind and solar continues to rise. Those two basically offset each other, leaving gas to supply about 40 to 41% of the power sources that they use or the fuel sources that they use in the power sector. So, a couple of different things there that keep sort of moving the ground underneath us in terms of gas consumption here in the U.S. On the production side, a 1.4% increase we think is in the cards for 2024, and the production numbers are up more than consumption, or the demand figures I should say, in 2024, and in part that's because this year has seen, in the early part of the year anyway, we were left with a lot of natural gas, excess gas in storage, and so that restricted midstream companies, adjusted their production to bring it back, adjusted their storage figures in order to bring them back in line by the start of this winter, and that's happened. But that left gas injections down about 10% from what they were the year before. So that has suppressed gas production numbers this year. We think, again, normal winter weather, a normal inventory situation on the gas side should mean a little bit stronger production requirement here in the U.S., and we think the elements would be in place for that to happen. And so we see this 1.4% increase in supply. So our assumption numbers look like this. We've got a $77.50 price on average for WTI in 2024, given that the average for this year is going to come in right on top of $78 a barrel. We just don't see much change in oil prices year to year anyway on the WTI side. Brent, those of you who follow that marker price, Brent prices we think will be up about $5 above where the WTI price is. So if we've got 77.5, we're looking at what does that end up being, 82.5 for Brent next year. Again, just up a tick from what Brent has traded at this year. A trading range is, again, we all understand the volatility in these numbers, month to month, day to day. So we think that a trading range will end up being somewhere in the 70 to 90 range for WTI next year. Henry Hub prices look a little bit better in terms of year-over-year recovery. So this year's numbers will come in around $2.50 to $2.50, $2.60. In 2023, we're continue to hold to a $3.50 per million BTU price on average for 2024. So we're up about 35% as that market tightens over the course of next year. So again, we always assume it's a common assessment that winter weather, that seasonal weather patterns will be about normal, and they never quite are. But that's underlying the numbers. So as Richard had mentioned in his comments, what's interesting is that spending for oilfield equipment and services will be up fairly sharply this year, in 2024. Even though rig activity overall doesn't change very much. So the chart on the left looks at active rig count in its three components, US, Canada, and international. And so while we see growth in both the Canadian and the international sector, the US numbers will be down slightly in 2024. The year-over-year numbers will be down slightly in 2024 compared to 2023, and that's what he was referring to. Not much help from the U.S. market if you're looking at total numbers of rigs running. But again, when you think about the spending on to complete wells, to drill wells and complete wells, and then to take care of wells that are in production. So a number that this year is coming in on a global basis, we think close to $300 billion. We think next year will be up about 9%, so that puts it close to the $325 to $330 billion number for next year. And again, much of that gain is really a function of what's happening in the international sector or the offshore sector writ large. So we enjoyed pretty good growth in terms of spending for oilfield equipment and services, off of course a very low number back in the 2020 and 2021 era. So, which came in by our lights around $200 million. So we're up about 50% from those dark days. But the growth rate does continue, we believe, skewed toward markets where the consumption is driven internationally or in the offshore sector. So let's spend some time thinking about what that means region by region. Here in the U.S., we've got this year's numbers. We'll see somewhere around 689 active rigs on average. And we think that the numbers next year will average for the whole year 648 rigs, so down 6% year over year. But as we had been expecting back in September, as we saw OPEC take these extra actions to try and support prices, we thought that the decline that has been happening in U.S. rig count would bottom out sometime in the fourth quarter and begin to recover. And I think we're seeing the early stages of that happening. Last few weeks have certainly seen a fairly stable rig count. We've got some signs of rig count picking up a little bit here in the U.S. So we've touched bottom, I think. And from this point forward, we expect a recovery to broaden and grow. So if you look at our numbers exit to exit, Q4 of 2023 to Q4 of 2024, what we see is about a 6% growth in rig count. We go from 620 rigs on average the fourth quarter of this year to 660 rigs on average in the fourth quarter of next year. So, going forward anyway, we do see growth happening, but when you measure it on a year-over-year basis, the numbers will be down about 6%, as shown on this particular chart. Frac job count, those of you who are tied more to the completion of wells rather than the drilling of wells, that's an interesting thing. Frac activity has been pretty steady this year, as best we can tell, although the number of new wells drilled is down, associated with the decline in rig activity. Frac activity measured in terms of jobs and even measured in terms of frac spreads has been pretty stable, as you can see from the chart. So very little change, somewhere around 13,000 new frac jobs, or frac starts, I guess is the right way to refer to that, in 2023, and not much of a change next year. So what that means, if we're drilling fewer new wells, but frac activity has stayed fairly stable. Yes, you're right, the drilled but uncompleted count of wells has continued to fall in 2023 relative to what it was last year. So that's allowed frac activity to stay fairly stable. And we would expect to see a slight amount of a decline in that uncompleted category occur once again in 2024. Beyond the point I want to make, though, is that beyond sensitivity to commodity prices, that's always been our main driver in our drilling forecast. And history shows that there's been a pretty high correlation over the years in terms of a change in oil prices with then a corresponding change in rig activity. But as we all know, the drilling activity is much less sensitive to the change in oil prices than it has ever been, as operators have become disciplined about their capital spending and less reliant on outside capital coming into the industry. What we see is that sensitivity, that correlation between price movement on the oil side and rig activity movement has just diminished greatly. And so as we think about 2024, some of the non-objective or non-quantifiable numbers that are actions that we think are important to keep note of there are three, basically. One is that pipeline capacity additions certainly affect activity in regional markets, and that is no truer than what you find out in the Permian Basin. So Permian Basin, as we're aware this year, has been short of gas takeaway capacity. There have been a number of new lines that are being built and have just begun to be completed. And so the situation improves across 2024, and then as more lines get built, the takeaway situation will continue to improve in 2025 and 2026. And so for example, you look at the price of natural gas at the Waha trading hub out in West Texas. It's been depressed, quite depressed this year, just because there hasn't been capacity to move gas to consumers out of that basin. That situation is being rectified, so we would expect natural gas prices to recover. Not only that would help cash flow for some operators, obviously, but in addition, I think that will help move both drilling plans and completion activity forward that have been delayed just because you can't bring a well online. Most of these wells out in the Permian Basin now produce a fair amount of associated gas. Flaring is increasingly off limits, And so you've got to have takeaway capacity for your gas in order to bring that oil well online. And that's just been a problem this year, but that problem is going to begin to resolve itself as time goes by, and 2024 will certainly improve that situation. So I think out in the Permian Basin, that will help support activity on itself. But as is always the case, one door opens and another door closes. The M&A story has been pretty dramatic this year. There have been any number of multi-billion-dollar deals, and just in the last quarter we've seen, of course, Exxon by Pioneer and Chevron by Hess. And now we see Oxy being proposed as a buyer for Crown Royal, and Chesapeake. There's other deals that might be done. I think the key, though, is that in years past, when we saw these kind of deals being done, what we expected and often saw was an increase in activity by the surviving company or by the combined entity, because you were typically moving assets from a cash-constrained operation to one that had deeper pockets, and activity rose following that. These days, I think the deals are being done in order to sustain the runway of undrilled prospects, right? And so it's not about adding production tomorrow, but rather sustaining the duration of output and growing it from 5 years to 10 years or 8 years to 12 years, those kind of things. So as has been the case for some of the deals done in the past 12 plus months, we've actually seen activity slow down by the combined entities after these deals have been effected. So I wouldn't be surprised if that is a factor that sort of takes away from activity in the marketplace going forward in 2024 and perhaps rolling into 2025 as well. So certainly M&A is not the medicine, the good medicine that helps the drilling industry like it used to. And then finally, the other thing I think we all need to pay attention to is the increase in extremely long laterals drilling extremely long laterals that is beginning to emerge in the marketplace. So by extremely long laterals, we're really talking 18,000 plus foot wells, right? 3 mile laterals. The average here in the US for the past 3 years has been around the 10,000 foot laterals. And indeed, we've seen 12 and 13,000 foot laterals contributing to that 10,000 foot average. But now we're beginning to see 18 and 20,000 foot laterals and perhaps even longer being drilled. And, as that happens, technology improvements in mud systems and so forth have allowed the wellbore to be, better control over the wellbore, I should say, and keeping it in the zone and whatnot. So it's allowed these long laterals to become effective. And as that happens, of course, now you can drill fewer wells all told, but and still achieve the same amount of exposure to the wellbore, right? And so this has an impact in terms of what rig count might be, because now you're not needing to drill as many unproductive feet, the vertical section of these horizontal wells, right? Because you're getting more bang for your buck as you extend the lateral. And so 2 20,000 foot laterals can do the same amount of wellbore exposure as 4 10,000 foot laterals, right? So you've got that kind of trend is, I think, another one that will affect rig activity and then the relationship between rig count and footage drilled and completions and so forth. And it also, once again, messes up the relationship that we've seen over time between oil prices and rig count, because really what counts is how much lateral footage you're getting to drill, and again, that relationship as we extend these laterals is changing. So all these points are factors that I think we need to consider and remember as we think about where activity is going over the next 24 months and for periods beyond that as well. Here's another thing I think we all should pay attention to, and that is the efforts on the part of operators to green the barrel by reducing their Scope 1 greenhouse gas emissions. So the numbers come to us from an inventory exercise across all industries that's conducted by the Environmental Protection Agency. And on the left, what you see plotted are the absolute tons emitted, couched in terms of millions of metric tons of CO2 equivalent. So because some of these emissions are methane, they've converted those methane emissions into a CO2 equivalent number in order to compare apples to apples. And so the black part of the bar represents the CO2 emission number, and the orange part of the bar represents the methane element converted into CO2 equivalents. And so what you see is that the numbers are down pretty sharply since 2019. There hasn't been much change over the past in 2021 and 2022. The 2023 numbers will be out about 12 months from now. So, but these exclude any efforts to that operators might be taking to either offset their CO2 emissions through carbon purchases or through carbon capture or anything. These are just the emissions element that we see happening from the oil and gas sector. These are just the oil and gas sector numbers. But because we've been increasing production, it's perhaps more informative to measure the intensity of our greenhouse emissions. So here we're expressing what these emission numbers that you see on the left-hand side look like when you talk about them couched in terms of the CO2 equivalents per barrel of oil equivalent, right? We produce oil, we produce gas, and so you convert the gas production numbers to a barrel of oil equivalent, and now you can begin to have all kinds of fun with math as it so happens. And so what we see happening is that, again, the overall intensity numbers are down about 33% since 2019. Much of that drop has been due to actions taken to lower methane emissions. So operators have really been busy in any number of ways, replacing pressure relief valves, conducting continuous surveys, aerial surveys, on-site sensors, and so forth, to be able to capture what would otherwise be fugitive methane emissions, which again is almost a no-cost approach, because the more gas you can capture and keep from losing to the atmosphere, now you can sell it, right? So you almost can help offset the cost of this enhanced maintenance work that you're doing. So we've seen that the intensity figures drop, and I put that in there that on average the industry around the globe emits about 25 kilograms per barrel of oil equivalent, and we here in the US are now down to around 8 or so, as it would appear. So so things are moving in the right direction. There's clearly work to go, and I make the point that as per our calculations, because of all the fracking, the frack activity that takes place emits about 18 million metric tons of this CO2. And on the drilling side, we've got about 7 million metric tons of CO2 that we're emitting through standard practices. So, and there hasn't been a lot of change in those kind of emissions, as best I can tell, over the past several years. So I think that represents a sort of the next horizon for the U.S. oil patch to address. We hear a lot about e-frac, and we hear about rigs running off of grid power and so forth. And I think those kind of exercises will be sort of the next frontier for the industry to take. Back to the drilling activity quickly. Here in Canada, we expect activity to grow about 5% this year. Again, remembering that, so the West WCS price is about $60 today. It was around $80 a year ago at this time. The AECO gas price is down also. So the Canadian numbers we believe, are poised to rise, not because there's a push on the commodity price side, but rather, again, because of the pipeline takeaway issue. There have been 3 or 4 big pipeline projects that have come on stream or are going to come on stream in 2024. And as that takeaway capacity improves, both for oil and gas, that we think will support an increase in activity on the upstream side. So much like pipeline takeaway and LNG export has supported activity here in the US for more than the past decade, this state of affairs is beginning to be an element on the Canadian numbers as well. So Canada up about 5%. International activity we think will rise about 9% this year in aggregate, as it has. So, you know, again, the international sector bottomed in 2021, whereas the bottom was reached in North America back in 2020. And then the core recovery in North America has been sharper, but is beginning to flatten out, and it's come down this year as we've seen, but it continues to roll forward in the international market. And it's interesting when you begin to sort of see where the regional growth is taking place. The numbers are kind of all over the board, but this year we've seen activity increase in all of the 5 regions that we look at, as you can see on this chart, and we expect that to be the case once again next year. So up about 11% this year, up about 9% next year, as best we can tell. The Middle East, these are percentage numbers, not absolute figures. So the Middle East doesn't appear to be the leader this year or next, but if you look in terms of the absolute numbers of rigs being added year over year, the Middle East accounts for about 40% of the growth that we anticipate in the international sector next year. So it's, again, key to the marketplace. When we look at the numbers from internationally, if we just look at the onshore growth numbers, again, we see numbers up about 9% in 2024, almost 780 active rigs, about 7,800 wells drilled. And on the offshore side, we see activity growing about 8%, again, a little over 200 active rigs as per the Baker Hughes count, and almost 2,500 offshore wells drilled. I should mention, again, when we talk about offshore rigs and international rigs, we're tying ourselves historically in the forecast to the Baker Hughes rig count. So Baker Hughes counts rigs that are actively drilling. There are other sources, particularly offshore, that count rigs based on whether they're under contract and earning money for their owner. They may not be drilling, and so they may be moving onto location. They may be waiting for other actions to take place, but they're not necessarily turning to the right. So some of these other sources end up with rig counts that are substantially higher, 30 to 50% higher than what Baker Hughes will count. But all of our numbers are Baker Hughes figures, the history anyway. The other thing I should point out is that while in most areas of the world we are classicists, we think of our Africa numbers are what the geographers would refer to as Africa, and not necessarily the same distinction that the way the Baker Hughes numbers are accumulated. For example, the Middle East in the Baker Hughes count includes Egypt, while for us, Egypt is in Africa. They've got Turkey in the Middle East. We put Turkey they have Turkey in Europe. We put Turkey in the Middle East, that kind of thing. So there's some adjustment there. The one place where we sort of break our own rules is that we put Mexico, which is, again, classically a North American country, we put it in the South America count. And that's simply because Pemex, a state-owned company, dominates activity in Mexico, and that's common to what we see in many of the South American nations, where it's really the national oil company that is the main driver of activity. So to just sort of make apples to apples comparison about the same, our South American numbers include Mexico rather than Mexico and North America. And then as we work our way around the world, just to highlight some of the important points. We've already talked about Canada and the pipeline takeaway situation, Central South America up about 6%. Petrobras just announced what its plans are to spend over the next 5 years, going to about $73 billion on E&P projects, so up pretty substantially from what it had been planning before. Mexico's got some offshore projects that are pretty interesting. That'll begin to take effect or take action next year. Europe's up about 4%, 101 active rigs. Problem we have in Europe is that in Norway, rigs are actually leaving Norwegian waters in order to work elsewhere, so that's constraining the amount of activity that can take place in Norway, since the rigs have to meet Norwegian safety standards, and they're the toughest in the world. UK has seen some projects approved, but Labour is poised to win the next election, and it's pretty negative in terms of what it would like to see happen with regard to taxes on North Sea oil and gas and a ban on future licensing rounds. So that's going to be a problem for them. And then finally, we look at Africa, Middle East, and Asia Pacific. Africa's up about 15% this year. It's really benefited from the interest in exploration. A lot of undrilled territory, both onshore and offshore Africa, and we've certainly seen that be a main driver of activity this year. One of the main new areas that's receiving a lot of interest is, of course, Namibia, and there we have three different groups: Total, Shell, and BW, all with big, world-class kind of discoveries. Nigeria is important only because operators there have promised to speed up the procurement process. That's been pretty slow and a fairly major source of disappointment for a lot of service firms I know. The Middle East, as we've said, any number of countries there seeking to increase their production capacity, either both for oil or gas, or both oil and gas in some cases. So a fair amount of interest going on in those areas. Saudi Arabia, just highlight the number that they will spend, let's call it $50 billion capital spending this year on their upstream sector. So it's not all going to drilling. A large amount of that is both brownfield work as well as surface facilities and the like, production facilities and whatnot, but substantially higher than what Saudi had been spending before. And then finally, we look at Asia Pacific, which is up about 6% this year. Any number of big projects there. Asia Pacific is dominated by India, Indonesia, and Australia. Those three countries combined to account for about 65–70% of the rigs running in Asia Pacific, and each one of those is seeing some improvement going forward. So we've got high hopes for what might be the case in terms of Asia Pacific markets. So with that, let me finish the prepared part of my remarks and slide over into the Q&A section, where Richard can rejoin the broadcast and we can take your questions in the time remaining.
Well, or Daryl Hall. Or am I John Oates? I can't remember.
There you go. Yes, sir.
We've had some really good questions here.
Let's hear it.
You know, so one of the overarching, one of the early questions was, what is driving U.S. demand for oil and gas? Because all you hear about is, threat of recession, blah, 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 blah. And yet you also now look at the stock market, which is all-time high. Yeah. So it thinks thinks favorably of the future.
So 60% of U.S. oil consumption is associated with the transport sector. So pedestrians.
Pedestrians. Yeah, we use a lot of
aiming
gas.
at production. No, both cars and trucks, over the road semis, that kind of thing. So the economic activity in the U.S. has, by all accounts, risen about 2.4% this year, right? And so that has helped lift our numbers a bit, and it's still forecast, despite all the worries and so forth, to grow about 1.5% next year. So we've got that going.
And that's actual demand. I mean, because you can talk about inflation, which is one thing.
Right. These are real GDP numbers.
These are real numbers here.
And we have to remember too that the population will grow almost 1% next year. So we just have more people. So it's a demographic issue as well as an economic issue. That's helping support U.S. oil consumption figures.
And population grows not necessarily because American women are having babies, but because we have a lot of people moving in from a variety of sources.
Absolutely right. Yeah. So we got.
So we have. So my friend Dave asked the question. It's specific to offshore drillers, and if you look at the forward-looking contracts of offshore drilling rigs, these guys are full. Like all their drilling rigs are booked up, and he says, through Q3 2024. I think it's longer than that. It's just like, try to contract a drilling rig for 2026. You have to actually then go build one. And so his question is, are there any speed bumps in that? Like what could be the disruptor in that where the E&P companies, both national and international, go, oh crap.
Right. Well, so offshore, typically about half of your drilling, half of the rig time, I should say, is associated with exploration. And so that's why, the offshore drilling market fell apart back in 2020, right? Because Oil prices
no
crashed
exploration.
and no exploration, right? So the rigs were let go, didn't get renewed, the whole 9 yards. And so that's the thing in my mind that could really disrupt, would be the speed bump. Because to the extent a rig is employed for the purpose of development drilling, be it shallow water or deep water, I mean, those projects tend to continue on. But it's the discretionary element for the offshore sector is clearly exploratory drilling, which is going to be a function of what do you think the price deck for oil is going to be over the next 10 years?
We actually got our very first geophysical market inquiry in 5 years yesterday.
Right. So, right, you got to figure out where you're going to drill. Where's the prospects, right?
Yeah,
So,
and it was a geophysical service company
Yeah, right.
going, I think what they're looking at is their business outlook is better.
Yes.
Because we've been drilling inventory. We've been pulling stuff off the shelf.
Right.
And now I've got to go actually repopulate the shelf.
Sure.
And so maybe there's a more firm outlook.
Either areas that we've conducted where a survey's never been conducted, or something's been done, but it needs to be done better.
But I thought that was a really interesting. I didn't even know what to do when I saw the inquiry come in. I don't know. Like, quick, call one of the Davids. They'll know.
Geophysical. Yeah. Okay.
So your view of offshore drilling speed bumps, there's not that many, because it's a long, slow moving growth trend here.
Yeah, absolutely. And you also have to think about who's doing the drilling. So for the most part, these are pretty well-heeled, deep-pocketed companies. So they've got the resources. It's just a question of, are they convinced that there's going to be the need for it, the need for those reserves of that production down the road. Because again, most of the projects are, when you look at cost billions of dollars on a per barrel basis, they're pretty low cost, $6, $10, maybe $20 a barrel. The reason more of them aren't done is because the tax take, of course, can be pretty substantial. 60 to 70% of the cash flow is usually taken by the host government, one tax or another. So, what it really comes down to is, does an oil company think that there's a need for barrels to be produced, 5 and 10 years from now? Because again, these are going to be long life projects, right? So you're not going to drill the well, stop producing from it, 18 months from now. It's not like those classic Gulf of Mexico shallow water gas wells, right? Which were, would play out in 36 months time.
Yeah.
So, this is a different animal.
You and I are associated with a managed pressure drilling company, and as I look at drilling rigs, especially the jackup rigs in the not very deep waters off of, in the Persian Gulf or whatever, the Arabian Gulf, whichever one you want to call that. I see a lot of drilling rigs that have contracts.
Yes.
I don't see a lot of drilling activity that goes on, just because these are not highly efficient operations. They put a lot of rigs to work, but there's maybe not a whole bunch of holes being drilled off of each one of these rigs. So lots of rigs, not a ton of holes being drilled, because it just takes a long time to ramp up.
Sure.
So, I wouldn't be surprised if there's a plateauing of offshore drilling rigs as the service sector catches up in order to populate the rigs with, rotary steerable and blowout preventers and managed pressure drilling, because that's the choke points.
The rigs themselves could become more efficient in terms of wells per rig, and that might be it.
So here's a question. To what degree have you already included the further conflicts that you see in Ukraine, Israel, and everything else that's out there? I know that it's you consider it because we actually now have, almost 2 years of conflict in Ukraine. We have the new but established conflict in Israel, and you go and so how are you? So does it end? Right. Is it the never-ending war?
Yeah, it's kind of interesting because I think what has the Gaza attacks initially, everybody worried that there's going to be a big hit to, or what could happen to Mideast production, right? But there have been some major gas finds in the Eastern Mediterranean. Israel has a couple. Egypt has been making some. Cyprus. There've been discoveries around Cyprus and whatnot. And so each of those countries hopes to is supplying gas to itself and its neighbors, and hopes to supply gas from other things. So I think there's an economic element of common interest that has, with regard to Israel anyway, Gaza, has helped sort of keep the situation from getting out of hand, because they have a common bond, as it were, and with regard to some of these gas fields and discoveries that have made Eastern Mediterranean. So that's kind of an interesting element. It's all gas, not oil, but I think that has, because some of these countries are actively trying to work together to develop gas resources, that has helped other countries sort of work together to keep lid on the situation with regard to Gaza and Israel. Ukraine is a crazy thing. That's really all about, isn't it, about how much Russian oil is going to get to the market. Russia produces 10 million barrels of oil a day. There's all kinds of structures as to price caps there are and who can tanker it around, and it's a very confusing situation. But I think at this point, just as the conflict itself has sort of reached a stalemate status, I think Russian has been redirected to different elements or places around the world, but that now seems to be a fairly stable pattern. So when we talk about speed bumps, it's hard to imagine what might really disrupt it. I don't think there's much interest on the part of Europe to clamp down any harder on Russia.
Because that's the big one.
Yeah.
I don't think I saw any difference in your September forecast before the Hamas attack and your December forecast after the Hamas attack and then Israel's response. Yeah. I didn't see that I could identify any impact on your drilling forecast.
Yeah, there certainly hasn't been much effect in the marketplace. There was for a few weeks.
So there's certain wars that matter way more than other wars. I mean, it's harsh to say. Matters to the people a lot.
Yes, right.
But to the industry,
industry's always worked around conflict, hasn't it?
Yeah.
So, but it really gets to in terms of what affects delivery marketplace. So there could be some things that might cause a problem, but we're not anticipating.
Here's a question I'm going to take before we run out of time. What are our comments regarding emerging technologies, not specifically green transition, that's going to impact the industry over the next 5 years? And here's just this. One of the reasons why you and I have decided to allocate some of my time to a geothermal company, Ignis Energy, you can look it up on the internet, is because we see a reason to participate in all the above options with regard to generating power, generating energy. And so here's Ignis Energy that has said, we're going to take oil and gas related technologies, the things the oilfield service company does really well, apply it to the geothermal situations that look a lot like developing a gas field. High enthalpy, really, really hot rock. So that I can, drill a hole in the ground, a bunch of holes in the ground, generate electricity, and provide power in a certain area. So nothing warm, nothing, no wave action. Things that look like an application of an oil and gas related set of tools and techniques in order to create electricity. And we're putting our time. I mean, you and I are allocating my time behind that. So look, there's always things like that going on. And oil and gas path, very clear. Geothermal path, not at all clear, but I think we have to participate in it.
You also see where Exxon is drilling a geothermal well to extract lithium, right? Over in Arkansas. So you get some things like that.
Our neighbors.
I think by and large, though, the fact that consumers aren't taking up electric vehicles as fast as would have been the case is it's contributing to the notion that some of this transition stuff is slowing down. We have an interesting question here. I think we can get it in. What's expected on...
This is an interesting question.
What's expected in terms of drilling and production from the Vaca Muerta shale play in Argentina? Because we've got a couple of pipelines coming on stream in 2024. So Vaca Muerta produces, I'll call it 200,000 barrels a day. Right now, there's been those who've said, we could get to 1 million barrels a day if we had the infrastructure and whatnot by the end of the decade.
In a country that you can count on.
Yeah, so it's a right. So it's always been, as a country, poorly administered, right? And so that's been a big hang up. But again, clearly, just like in the U.S. and our LNG exports, Canada and the pipelines and plans for LNG exports. Australia several years back and its LNG exports. I mean, it's really all about the infrastructure to get your oil and gas to a place, and once it's in place, that can really lift activity going forward. So
I mean, they got
if
the
you've
rock.
I think you demand for it. Yeah.
They've got the rock. They've got the reservoir.
The problem right now is for them is that their oilfield service infrastructure, rigs, the frac crews, that's going to be get the pipelines built. Build it and they will come, but they're not sitting there right now. The frac crews, the rigs aren't sitting there right now to double or triple or that kind of. So that growth rate, I think, in Waha will be measured. It will grow, but I don't think it will be rapid ramp up that we've might have seen in other places.
By the way, we very much appreciate YPF as one of our great clients.
Right,
Thank you very much, YPF, for all the years of support.
Yep.
Last question we're going to take is now it's 10 o'clock. Are there any concerns with the Saudis and the Chinese going away from the petrodollar?
Oh, right. Oil
you didn't see that one coming, did you?
No, oil's been traded in dollars forever. Now, the Russians want it traded in rubles, and the Chinese want it traded in yuan.
The producer of our show wants to trade it in Bitcoin. Whatever that price is.
There you go. That one's a hard one to figure out. I think it goes into bigger issues regarding how debt is held and larger issues around trade. So we don't have I don't have a view as to how that might affect things. Although it does help tie producers to consumers in certain areas.
And you and I our firm has all of the big national oil companies in the Middle East as clients. And even with that perspective, I can't tell. I don't think we are ever going to know what
it's
their
not surprising. It's not
intent
surprising,
is.
though, because you think about it. Europe is trying to wean itself off of oil and gas. And the U.S. Is largely self-sufficient, right? Oil and gas, and net basis anyway. So it only makes sense to me that in light of those two big markets, not as reliant upon the Middle East oil supplies as they have before, that of course the Middle East, Far East, and that being the case, well, of course we see trade happening in terms of something other than the dollar. So I think it's a very natural outgrowth of how the resource base uses from has changed in the past decade or so.
I'm still going to bet on the U.S. dollar in this industry for quite some time.
Yeah, probably so. I think most of the trading goods.
Yeah.
Anyway,
Amazon.
Good. The only other question I have for you, Richard, is what's your favorite Christmas?
I'll be home for Christmas.
Mine's 6 White Boomers. So we'll end on that note, and hope to see you again come March when we update our forecast. If you have any questions in between, give us a shout. You can reach us any number of ways. Happy to answer any questions you have. Take care.
Go Pokes.
Thank you.